now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. Welcome to the show. This morning, of course, it is Thursday, second best day of the week. And of course, that also means Michael Liebowitz is joining us today to talk a little bit about the big story this afternoon. Will be Jerome Powell speaking this week. And again, we've had just a slew of Fed speakers out all week long talking, basically giving speeches about various things. But everybody kind of glued to what's the next step here for the Fed. Is it higher for longer? Is it more rate hikes? Have increases in interest rates done enough at this point? That's all the big questions that markets are looking for answers for. And today, of course, is Jerome Powell himself. And so we'll get into what he may or may not say today here in just a few minutes. But outside of that, though, yesterday the markets did sell off. And again, we picked up a little bit of kind of turbulence yesterday, and again, when the markets were selling off earlier in the day, came down and retested that 20-day moving average. Again, as we've been talking about here lately, we're just kind of stuck here. Not really a whole lot of news yesterday. We're still going through earnings season. Last night, Netflix reported earnings much better than expected. Stock's going to be up about 13% this morning. On that news. And again, we saw Abbott Labs as an example report earnings yesterday, better than expected. Stock was up about 3% yesterday. So again, we're seeing companies coming out, beating estimates. Forward guidance hadn't been terrible at this point. So, and again, as in Netflix's case, looking for a continued strength in their subscriber services, looking to actually raise prices. And again, we talk about right now, people kind of struggling to make ends meet, but you still have companies with that pricing power able to raise prices. People want to pay for the service and they're willing to pay more for it. So, where's the limit, right? Where's the limit to where Netflix raises prices and people go, yeah, no, I'm not going to pay it. There is a limit. I just don't know where it is. And Netflix hasn't found it yet, apparently. And so they're going to be raising prices. That is all good news for Netflix. So again, they continue to grow their business. Stocks are going to get rewarded for that today. But again, estimates had come down a lot, as we talked about before. We're in that millennial earnings season period where, companies are beating estimates, but you have to remember these estimates were lowered a lot before we actually got into the reporting. But nonetheless, this is going to help give the market some support. And so markets are going to open kind of flattish this morning. We'll see. Markets are really kind of stuck between what's happening right now with, earnings, of course, being a little bit better than expected, but struggling with these higher rates right now. So again, higher rates, that does impact future earnings growth, does impact, valuations, et cetera. There is a measure of that as interest rates are ticking up here. That is certainly, kind of providing some stress to the market. So again, we just kind of really remain stuck here at the moment. Outside of that, yesterday also, again, President Biden in Israel, of course, didn't really do a lot to relieve tensions. What's happening there, and of course, that is also providing some additional weight on the markets right now, kind of uncertainty about what potentially does this spread into a wider war, right? And that's also certainly giving some concerns to investors about the potential of what the ramifications of that could be on markets as well. So but again, as we kind of look at the different areas of the markets, and again one of the byproducts of concerns about war in the Middle East is oil prices. Despite the fact that, we've got this conflict going on in Israel, oil prices did move up here, but not dramatically so. There was a lot of talk about as soon as this happened that we'd see oil prices, here comes $150 in oil. And that really hasn't happened yet. Yes, we've seen oil prices tick up here a bit. We are close to triggering a little short-term buy signal oil prices, which could suggest a bit higher price in oil. But again, oil prices really fairly contained within this kind of trading range they've been in here now for a while. So again, despite what's happening in the Middle East and Israel in particular right now, it really hasn't translated into this big spike in oil prices that everybody expected. That was kind of that immediate kind of knee-jerk reaction. Gold prices also, they've been recovering here, but gold prices had a very, very big decline previously this year, and we have been getting a little bit of a bump here in gold prices. We went from about $1,800 an ounce back to about $1,900. So gold prices up about $100 on concerns about what's happening in the Middle East. But again, you have to remember this is coming off a fairly big decline in gold prices that we had earlier this year. So again, when we kind of take a look at the broader picture, yes, there's certainly concerns about conflict in the Middle East, but it really hasn't translated a lot yet to some of the areas of the market that people really kind of expected it would. But here's what you need to know before the bell this morning. As I said yesterday, the markets did trade off to the 20-day moving average. We just kind of really remain trapped at this moment, kind of within this range, and we continue to kind of build this compression and price that we talked about on Monday. So markets are going to have to break out of this range at some point in one direction or the other. And again, a break to the downside. We've got support at the 200-day moving average. That's about 4,020 on the S&P index. A breakout to the upside, we're going to retest this kind of 4,500 level that we had back in June and July. So again, markets remain fairly compressed right now. Earnings are supporting markets on one side, concerns about interest rates and what's happening in the Middle East weighing on markets on the other side. So traders kind of trapped here a little bit in terms of kind of where we are at the moment. Once we get to the end of the month, and as we've talked about before, we'll get some additional support from buybacks that will start in November when that window opens back up again. But this week, the rest of this week, next week in particular, we're going to get a lot of the big mega cap names coming out, Apple, Microsoft, etc. So that should help provide some, provided they say good things, that should help provide some support to the markets. Real short term, we were overbought, so we're kind of working off some of that overbought that we had picked up from that rally that we had last week. So again, a little bit more work here. We're still on a buy signal right now at this point from a fairly low level. So again, there's not a lot of concern at the moment, but again, you'll kind of keep a watch on this 20-day moving average. If we do kind of break through that with some vigor and confirm that break of that 20-day moving average, we are going to kind of look at support at the 200-day. So there's certainly risk to the downside here currently. So don't negate managing risk in the portfolio right now. A break to the upside obviously would be a much better story heading into year end. And again, we'll see what we have to do when we get there. But right now we just kind of remain stuck. And I imagine this is going to be the case, is kind of sloppy trading through the end of the month. Once we get into November, things should start to shape up here a little bit, both from just a technical basis as well as a seasonality basis as well. November, December tend to be better months than the month of October. We had written previously that October weakness was likely, and that's exactly what we've seen so far. But once we get to November, that should shape up here a bit. Again, barring something much more negative coming out of the Middle East or a dramatic spike in interest rates. There's a lot of things that could derail this market short term, and we're going to talk about some of that this morning with Michael Leibowitz when we come back from the break. But that's what you need to know before the bell this morning. When we come back, more with Michael Leibowitz. Also get by the website, his latest article on the website right now, realinvestmentadvice.com. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So, again, markets kind of sold off here a little bit yesterday, and it was kind of a steady selling drip kind of all day yesterday, which was a little bit different than we've seen the last few days, where we've seen kind of late day buying coming in. Markets have been selling off, and then you get some buying coming in, and particularly in the late day, which usually institutions coming in to make those purchases. Yesterday was a little bit different. Just kind of saw a steady drip kind of all day long in the markets, and markets did finish lower. This morning, futures are kind of flattish. Dow's down about 30, Nasdaq's up, mostly because of Netflix. So we'll see kind of how today kind of shapes out. But of course, the big story, of course, has been interest rates, and that's we've had a very sharp jump in interest rates here just over the last few days. Really not news driven at all. There's nothing really driving the spike in interest rates. It's just a momentum move, and again, just as with the markets, you have the same type of momentum in the bond market as well. So you have a lot of people that are a lot of these CTAs, these computerized trading algorithms and hedge funds, et cetera, shorting bonds. And so when you have that kind of pressure in the market and that momentum trade going on, it can last and can push things further than you think. But again, as with all momentum trades, they eventually end. It's just the question of when do they end and what causes it to end, and what that reversal eventually looks like. But this is, in terms of a momentum trade, this is now the longest momentum trade since 1973. So it's been a very long duration in this momentum over the last year or so in interest rates. And of course, that's what's been kind of weighing on markets, weighing on sentiment, et cetera, weighing on the economy. Not surprising. So, but the question becomes, this rise in interest rates, is kind of the interesting tale here, because the Federal Reserve has been hiking interest rates in order to get interest rates to restrict monetary policy, right? To make things more expensive in the economy, to get the consumer to slow down, to lower the rate of inflation. Up to this point, really, interest rates on the 10-year Treasury example, have been kind of hanging in there at their own level, and then hadn't really been corresponding to the hikes in Fed rates. But all of a sudden, it's been kind of a catch up with the 10-year yield versus the Fed funds rate. So all of a sudden, we've kind of had this jump in interest rates, and the question now becomes: is the bond market doing the job of the Fed? And this has been kind of the question that everybody's been watching these Fed speakers. Of course, today is Jerome Powell. He's giving an address this afternoon, and the question is, what is he going to say in regards to what's happening with interest rates and Fed policy as it relates to their next moves? Again, their meeting comes up October 31st, November the 1st is the next Fed meeting. And the question is whether or not they're going to hike rates, reiterate higher for longer. All eyes of the market are now glued on this next Fed meeting. Michael, welcome to the show this morning. What do you think Jerome Powell is going to say today, and what do you think about the current state of things as they are?
So there have been 6 to 7 Fed speakers, and I probably haven't seen them all, but at least 6 to 7 that have said that higher rates are doing the Fed's job for them, and higher long-term rates. So the Fed controls short-term rates; they don't control long-term rates, but it's really long-term rates, 5-year, 10-year, 30-year rates that really control the economy. Mortgage rates, auto rates, when a company borrows to buy a factory, investments, the government's borrowing rate. Those are the rates that really drive the economy. And the Fed increases short-term rates to help push long-term rates higher and create and slow down economic growth and hopefully take the legs out of inflation. So what we've seen over the last week is clearly an orchestrated effort to tell the market that the long end of the bond curve is doing their job, that they don't have to raise rates because long-term rates are going higher. The question today is, will Powell reiterate that? And given that these 6 or 7 speakers, and again, probably more, have literally said the same exact, the phrasing is almost identical.
Right.
I suspect he's going to say the same thing today. And what will the effect be? I don't know. But clearly, we're at a point in the interest rate cycle where interest rates are driving the stock market at this point, right? If you watch the bond market and watch the stock market, stocks really struggle when interest rates shoot higher. And we've seen a couple instances of that. A day or two, stocks can go higher with rates going lower, but it seems like they always keep catching up.
Right.
And the reason for that is that the value of we're in a leveraged society. So the value of all assets, be it stocks, houses, factories, cars, you name it, everything that produces income that helps the economy grow is a function of interest rates. And as interest rates rise, the value of those assets inherently decline. In the financial markets, the decline is measured in the price change day to day, and sometimes that inherent value can take a while to show up in the market. But I think we're starting to see that, and we're starting to hit the point where we've talked about this crisis. Whenever the Fed raises rates, there's a crisis, a financial crisis, an economic crisis, a bank, a country, a county in one case, a sector of the market, something happens. And it really feels like we're getting close to that point. Bank of America just said they have 125 billion of losses, unrealized losses on their books purely because of interest rates. That means every other bank has a massive amount of losses on their books, which also means that many investors, pension funds, endowment funds are sitting on similar losses, even countries. So in my opinion, Lance, it's a question of when does something break? And every day that rates keep doing what they're doing, especially over the last week, the odds of something breaking increase dramatically. This isn't a slow trickle anymore.
Yeah.
You're getting pretty close to the Fed having to step in and having to protect someone. And how they do it and who it is kind of the big question at this point.
Well, we're going to have a couple of interesting data points to look at this week. First of all, we have a ton of regional banks coming out this week. And this has been, where with interest rates lower than they are now. With interest rates lower previously than they are now, we had a regional bank crisis back in March, and today you've got Truist Financial's reporting, KeyBank. Quite a few other, Western Alliance, which was one of the banks that was on the ropes back in March. Western Alliance was one of the banks that were one of the bigger concerns about risk of default, and they're reporting earnings today. So it'll be very interesting to see, with interest rates higher, what does their loan book look like at this point? What is, are they having stress here? Or is everything fine? Did this bank term funding program that the Fed put together to bail out the regional banks, is it doing its job, right? Is everything okay? But there is an interesting, and you've written about this before. Back in 1987, you had interest rates spiking up, And, back then was this whole thing called portfolio insurance. And, the financial markets had thought they had figured out how to protect portfolios in kind of all environments. And of course, that unwound very quickly when interest rates spiked up. And of course, you had the crash in 1987. And there is kind of an interesting correlation if you look. And I'm not big on analogs. There's a lot of analogs running right now. That this market looks like that market because of the price action. But there is an interesting analog between what markets are doing right now versus interest rates that led up to the crash in 1987. I'm not saying we're going to have another crash in 1987, but to your point is that whenever you've had spikes in rates, particularly in an increasingly leveraged economy, you typically have some type of financial event, whether it was 1987 portfolio insurance, long-term capital management in 1998, the Russian debt default, Asian contagion, the dot-com crisis. I mean, you can just kind of pick them out. Whenever you've had big spikes in rates, the negative consequence was never really a great thing.
Right, right. And here's that we talked about this, I think it was last week. Long-term capital was a hedge fund making what some would say were smart bets. They weren't really stupid bets, but they were leveraged. All hedge funds are leveraged. Most institutional investors are leveraged. That means they're borrowing money from someone to invest in the markets. And when investments go against them, it means that hedge fund is potentially out of business. But more importantly, it means that all the banks that lent them the money are on the ropes, are on the hook for those potential losses as well. So when you're in an environment like this, where hedge funds that are betting the wrong way on any number of assets, when things go sour for them, it's not just the hedge fund that you've probably never heard of that goes under. It's the counterparties, it's the banks, and the banks are leveraged to each other as well. So, it's a series of dominoes, and it doesn't take much of a big domino to set off a bunch of dominoes, especially in a skittish market.
Right.
And, we saw this with the regional bank crisis. It was one bank, two banks. All of a sudden, there were 6, 7, 8 banks growing in size: PNC, Charles Schwab, Toronto Dominion. So, these dominoes can go pretty quickly, and it's just that first domino, which is probably going to be a domino no one's ever heard of.
Right. Well, and it'll be something too. Again, we have a tremendous amount of shorting right now going against treasuries, which requires leverage. So you have, the actual crisis could show up. And again, I'm just, making assumptions. But you could actually have the crisis show up in these hedge funds that are shorting bonds. So, it just depends on where it shows up and when. And to your point, you never know where it's going to be. It's just a function of when more than anything else. And then realizing that that's going to be the moment that kind of everything changes from what we think is going to be the case to what is actually going to be the case. So come back from the break, pick up with Michael Liebowitz. Lots more to get into this morning. Stick around. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Bond math is confusing. It's like my wife's girl math. She's convinced that if she buys something at 50% off, she made $50.
The Real Investment Show podcast.
She's now coming up with things about guy math. Every time I buy a new gadget at the house, she's like, guy math. I'm like, hey, yeah, but I save money because I don't have to work as hard. My time is worth money, so I'm saving money if I buy something that reduces my workload at home.
At realinvestmentadvice.com.
Guy math.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, Mike and I pick on the Fed a lot because they say a lot of things, and a lot of it doesn't make a lot of sense sometimes, but, you would think with, an organization with 400 PhDs that they could figure basic math out. I'm going to digress here just a quick second because there was an article that popped up this morning on the Wall Street Journal. This is from the Wall Street Journal Central Banking section of the Wall Street Journal. Talking about student loan repayments. And again, this is one of those issues that's, one of the concerns of the markets right now because student loan payments have restarted. And so this is the article from the Wall Street Journal. I just want to read to you two sections very quickly, and then we're all going to do some basic math here for just a moment. But then I want to talk about bond convexity and yields. We had a lot of questions from yesterday's show with Danny. We were talking about the potential return on bonds and, kind of basic bond math. And we had a lot of questions come in after the show yesterday asking more about the bond math. So Mike and I will get into that a little bit this morning. But let me read to you these two sections. And Mike, this is Michael Leibowitz right now. He's with me. He's completely cold on this topic. He doesn't know anything that I'm about to tell you. But Mike, I want you to play math professor with me for a moment. You're good at math. And I just want you to kind of follow along, okay? So millions of student borrowers are likely to curtail their consumer spending by only about $56 a month as they restart payments on student loans. This is according to the Federal Reserve Bank of New York data. Across 28 million federal student loan borrowers, this amounts to about $1.6 billion less in consumer expenditures every month. Okay, so just a little nip, right? So you go through the whole article, and down at the bottom of the article, they say this. Now, just keep in mind, 28 million, that's the number of borrowers. Mike, you with me? 28 million borrowers, and they're only going to reduce spending by $56 a month when they restart their student loan payments. So 28 million, that's the number of people. Down here at the bottom of the article, it says, the U.S. government paused federal student loan payments in the early weeks of COVID-19 and pandemic in 2020. The 43-month breather in payments, so we need to know the number 43 months, gave borrowers $260 billion in waived payments throughout the pandemic that could be used on other consumption or saved in bank accounts. Okay, so we have three numbers that are very critical here. 28 million borrowers, 43 months, $260 billion. So if we take $260 billion, divide that by 43 months, and then divide that by the 28 million in borrowers, that means they were saving $215 a month if we do the math. So how is it now that going forward, they're only going to spend $56 a month on student loan repayments when their payment, the average payment was $215 they were saving previously? So this is Fed math. So now we've had girl math, we've had guy math, we now have Fed math. And this is why you've got to be careful reading headlines and make sure that you do the basic math. Mike, any comments before we get into bond math?
No, the math doesn't make sense, but bond math does. Bond math does. So let's go over there.
Yeah. So, all right. So we have girl math, we have guy math, we have Fed math, and now we'll have bond math. So yesterday, Danny and I spent a few minutes talking about, kind of basic bond math, and we were going through and using the example of a 30-year Treasury as the example, and talking about if interest rates go up, 300 basis points from here, the decline would be about 29%. But if interest rates fall 300 basis points from yesterday, then you're looking at a 72% gain in that bond. And so we had a lot of questions about that in relating to both basic kind of bond math. How does that work? And also a little bit about convexity. So I thought we could just talk a little bit about that this morning because, again, we just had a lot of emails yesterday going back and forth. You didn't see all of them. There was a lot. But going back and forth talking about, how this works. Why is it that there's such a big potential gain in bonds when yields fall? So I just thought I'd let you kind of go through. Let's just talk about yield and price first, and we'll talk a little bit about convexity.
So let me actually talk about duration, because yield and price are a function of duration. How much price moves for change in yield is all about duration, and convexity is a function of duration. So duration just is essentially a measure of your average payment. So let's think about this. Let's take a 10-year bond, and we have two bonds. One bond is a zero coupon bond. So in theory, you buy that bond at 80 cents on the dollar, and it matures at $1 in 10 years. In that case, the price will go from 80 cents to $1, and you're going to make 20 cents over the 10 years. That's your yield. The duration on that bond is 10. Your average payment is going to come in 10 years. Now we take a 10-year bond that has a 5% coupon. So every year you're going to be making on that $1 investment a nickel. Every year there's a nickel. So you have a stream of nickels, and then at the end you get back your $10. The duration on that bond is somewhat less than 10 because your average payments is not 10 years. You have all those coupon payments. So for a 10-year bond today, it's about 8. So your duration is 8. So you now have a duration number. With that duration number, you can approximate if yields go up or down, what's my price gain? And the math is simple. For every 1% yield change, you just multiply it by the duration. So if your duration is 8, if yields go up 1%, you're going to lose 8%. If yields fall by 1%, you're going to make 8% on top of the coupon. Mm-hmm. Both are on top of the coupon.
Right.
So the way I just described it, duration is linear. So if rates fall 5%, you're going to make 5 times 8. If they rise 5%, you're going to lose 5 times 8. But the duration does change slightly, so it's more, it's hard to describe with words, but it's more of like a little bit of a U shape.
Yeah.
Convex a little bit. So as yields fall, you're actually, the duration will increase slightly. So what's going to happen is that when we estimate these changes, they're actually better if yields fall decently. The approximation we made earlier will actually be slightly better, and when yields go up, the approximation we made when you start talking about 2 or 3% higher will actually be not as bad as we thought they would be.
Right.
The key, I think, for most people that are not trading bonds, that are not in the weeds with bonds, that are not professionals, is just look at the duration. That's a very simple number. You can get it on, Fidelity. If you buy a bond, Fidelity will tell you that duration. Charles Schwab will tell you the duration. There's probably 100 other sources to find that duration. And even as an approximate, you can sort of assume, and again, it depends on the coupon, so I don't want you to take this too literally, but you can assume it's roughly 70 to 80% of the maturity. So if it's a 20-year maturity, say the duration's about 16 years, 15 and a half, something like that. And it works for a 1-year bond, a 20-year bond, a 6.5-year bond, you name it. So focus on the duration. If you think rates are going to go up 1%, it's that times the duration. But you have to factor in that you're getting a coupon. And this is where bonds start getting a little interesting given current levels. If we take a 10-year bond that says has an 8-year duration, if rates go up 1%, we're going to lose 8%, but we're going to make 5%. So we're going to lose 3%. If bonds go down 1% in yield, we're going to make 8% because of the price rising, and we're going to make 5%. So you're looking at a risk reward of 13% on the upside and minus 3% on the downside. Mm-hmm. So, when you start thinking about yields and how much higher they can go and duration, and you put all this together, the risk reward ratios start looking better and better. And we were talking about stocks earlier. Another reason stocks may be struggling is because you can lock in 5% for a risk-free treasury and 6 to 7% for a very good, high-quality corporate bond. At what point do you say, you know what? I'll take that high-quality corporate bond. Why am I investing in stocks that tend to average over longer periods, 7 to 8% returns anyway?
Well, and not only that, right now, for the first time in 20 years, the yield on a 10-year Treasury is higher than the earnings yield on stocks. Now, I'm not a big fan of earnings yield. I think it's math hooky because you don't get an earnings yield on stocks. But if you want to use the inverse of the valuation, right, which is the earnings divided by price, you can get the earnings yield. And we just haven't had a period really since 2000 where the 10-year Treasury rate was higher than the earnings yield on stock. So again, just kind of this other, side of the bond math that says, you're almost better off buying bonds here than you are owning stocks.
Yeah, I mean, look, if we offered, equity investors 15%, I guarantee you 99% would take the 15% and run. If we offer them 0%, which is the world we came from, they're all going to chase equities.
Yeah.
So we're on that spectrum, on that continuum, and the closer we get to 15, the more investors you're getting that are going to sell stocks and just buy bonds and ride it out in a risk-free asset until stocks are cheaper and bond yields are lower.
Well, you say that, but when we come back from the break, we'll talk about the last time that you couldn't sell an 8% coupon. We'll talk about that when we come back from the break with Michael Leibowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So just talking a little bit about, yields and, talking about right now you can buy a treasury bond with a higher yield than you can get on stocks. And it's interesting because, Mike made the point, and it's a good point, right? That, when yields are zero, everybody wants to buy stocks. That was there is no alternative conversation that we had for basically a decade during the, Fed QE programs, et cetera. Yields were zero. So there was no alternative. Couldn't keep money in a money market account because you weren't making anything. So you had to buy stocks, right? So that is there is no alternative thesis to markets when yields are zero and stocks give you a higher earnings yield. And like Mike said correctly, that, with a 5, 6, 7, 8, 9, 10% yield on bonds, all of a sudden those are becoming much more attractive relative to owning stocks. Why take the risk in stock markets when I can just buy a yield and sit on it and get paid? Right, and then get my money back. Importantly, when a bond matures, you get all your money back. It doesn't matter what happens to the price, but at the end of the day, you get all your money back plus your interest payment, and that's certainly a much better alternative. But it's interesting, Mike, because this is where psychology, investor psychology, becomes important. Because back in 2000, as a good example, we could buy CDs at 8%. And the reason I bring that up right now is because mortgage rates yesterday on the 30-year mortgage hit 8%. First time since 2000 that we've had mortgage rates at 8%. But back then you could buy a CD at 8%, and you could not sell investors CDs at 8%. Why? Because at that moment, Jim Cramer was talking about the 10 stocks for the next millennium, which were all .com stocks. And, everything was going through, kind of, barn burner through the roof. Enron was skyrocketing, et cetera. And for a moment, why would I want a lousy CD paying 8% when stocks are going through the roof? And, it's almost kind of that same situation we see that today is, you have this very negative sentiment on an asset class that both matures at face value and is paying you a decent yield to sit in a risk-free asset over the course of the next, 5 to 10 years, however long you want to own it, versus valuations on stocks. It's kind of just an interesting conundrum that we're, kind of back to that analysis where I know bonds are terrible. I don't want to own them. I only want to own stocks because they're going up.
Right. You're right, Lance. It's both equity valuations and bond yields. And you have to put both of them together. Bond yields may go to 8%, but if, let's just say, the stock market gets cut in half today, expected equity returns will probably be much better than 8%.
Right.
So, while yes, I can lock in 8%, my expected return on a stock, if it gets cut in half today, which isn't going to happen, is much better. So you're always looking at the expected return differential. And for the last 10 years, that expected return differential was the expected equity return, even if it was 4 or 5% because valuations were high, versus 0 to 1%. Well, that whole math has changed now. And the problem, I think that stock investors are starting to sense, is that valuations are still high. So their expected returns over longer periods are below average. So again, if average is 7 to 8% and expected returns in stocks are 4 to 5% at current valuations, bonds make a lot of sense here, at least shifting from stocks to bonds, not wholesale selling stocks and buying bonds, but shifting your balance from stocks to bonds. And every day that yields go higher and stocks don't fall commensurately, the case for bonds grows. Whether individual investors are really attuned to this, I think some are, some aren't. But institutional investors, think about pension funds and endowment funds that have set target rates they have to meet. If your target rate is 6% and you're a pension fund manager or a big institutional fund manager, your goal is to meet 6%, and you can buy a solid AA corporate bond for 10 years at 6.05%, you've basically done your job for the next 10 years, assuming that company doesn't go out of business.
Right.
So, the case for chasing risk assets goes down as yields go up. And this is, again, it doesn't happen overnight. This is the lag effect within the markets. And every day that goes on, there's another investor that has that aha moment. It's like, screw it. I'll take the 5 or 6%. I'm good.
Right.
And in time, that wears on the equity market until equities come down in price and become cheaper. And then, if we could get to a point a year from now where equities are cheaper and bond yields are much lower, and all of a sudden equities make a lot more sense than bonds, and you get the switch back from those bonds back into stocks.
Which is interesting when you say that, because, we've been, in this exact situation, previously. And again, this is, we talked a lot about investor psychology and the mistakes that investors make a lot on Tuesday of this week on the show. Because, right now bonds are very undervalued relative to where they should be, and nobody wants to own bonds. There's a million reasons why interest rates are going to go higher from here. I love the latest, notice, which is, people running around saying, oh, it's the deficits. We're going to have this continued rise in deficits, which are going to create a more inflationary, a higher interest rate environment. That's not true. We've been running deficits since 1980, and as that trend of deficits has been growing since 1980, the trend of yields has been lower, not higher. So that argument carries no weight whatsoever. However, in 2008, stocks are down 50%. By the way, bonds are down 50% from their peak. Worst drawdown in history. Nobody wants to own bonds. In 2008, nobody wanted to own stocks either. And then that was the best time to buy things. So again, investor psychology is always very interesting to watch. And as any great investor will tell you, you want to buy assets when nobody else wants them. You buy panic, you sell greed. And this is one of those instances, just like we saw in 2008, where you've got an asset class that absolutely nobody wants, which certainly to me looks like a really good opportunity to start buying something.
Right. And you made an excellent point about the deficits. The government has a negative economic multiplier. So when they spend money, it does help the economy at first, but over the long run, it actually hurts the economy. So as these deficits grow, your economic growth in the future is declining. The economic growth rate is declining because so much of their spending is non-productive. It doesn't, think about it, we're sending money to Ukraine. They're buying bombs. They're dropping it on, whatever they're doing with them. And yes, Lockheed Martin or Raytheon is getting some money up front and they're paying employees and that goes through the economy. That's great for about 3 months or 6 months. But now the government owes that money and it becomes a weight on the economy. So, the cases the people are making for these deficits being behind higher interest rates are actually false. If you're looking at a 3 or 6 month bond or a 1 year bond, that's a different story. But when you're looking at 10-year, 5-year, 7, 10, 30, 20-year bonds, all the longer term bonds, it's actually, they're wrong. They're actually slowing down future growth. And over the course of 10 years, much of that growth, 8 of those 10 years will probably see the slower growth from the higher deficits. And, Lance, the other misconception is that the Treasury, Janet Yellen, they're just issuing like crazy. They have no control anymore. And look, government spending is out of control. It's been out of control. And when you look at what they're issuing and what the deficits are compared to the past, they're not abnormal. The economy has grown $5 trillion since COVID. That's a lot. Debt has grown, but it's grown in line with that. And in fact, after the initial spike in debt due to COVID, our debt to GDP has come down slightly. So, one can make the case that, they're spending more, but as a percentage of the economy, they're actually spending slightly less. Mm-hmm. So, you have to poke holes in these narratives. You have to really, like your student loan example, you have to really examine what they're really saying and does it make sense and use some math. And when you start doing that, you realize that a lot of these narratives of why rates are going up are not right. The reason rates are going up is, like you said, momentum. Traders sense momentum. Yields are going high. Everyone's hopping on a momentum trade, just like they hopped on the NVIDIA trade, just like they hopped on AMC when that was going up. Bond markets are markets like any other market, and investors will chase them in one direction or the other.
And again, when that reverses, that covering forces a big reversion in the other direction as well. And I think it's interesting right now because there was a really great chart. I wish I could share it with you right now, but I've got my video feed tied up with Michael's face at the moment. But on Twitter this morning, if you go to my Twitter feed, at Lance Roberts, you can see this chart. But it's the net purchases of U.S. Treasuries. One of the big fallacies running around right now is like, nobody wants to buy our bonds. That's why interest rates are going up. It's actually not true. This chart, it breaks down purchases, who's buying our treasuries. The only seller of treasuries is the Federal Reserve, right? The U.S. financial sector has been buying bonds a lot. Households and nonprofits, they're buying bonds. Other domestic investors, they're buying bonds. The rest of the world, right? They're buying our bonds. They've got to store reserve currency. Yes, our total purchases are down a little bit from last year, but the only seller is the Fed. And so on a net basis, if you took out the Fed, the buying of bonds is about normal for what they've been over the last several years. So, all right, Mike, that wraps up the show for the day. We'll come, of course, you'll find all this stuff on our website, of course, at realinvestmentadvice.com. Check out our Twitter feeds, at Michael Leibowitz, at Lance Roberts. Mike and I both post stuff there every day. So if you have a Twitter, or I'm sorry, X, just go back to calling it Twitter, will you? You can follow us there as well. We make comments every day, keep you up to date on the data. It's all there for you. realinvestmentadvice.com. Have a great day. We'll see you back here tomorrow with Financial Fitness Friday.